In the spring of 2025, the Trump administration sent shockwaves through the American auto industry with a bold and controversial move. The White House announced sweeping new tariffs, targeting not just finished imported vehicles, but also the countless parts that make up modern cars. This decision marked a dramatic escalation in the ongoing debate over trade, manufacturing, and the future of American industry. The tariffs were designed to hit imported vehicles and auto parts from Europe, Asia, and even neighboring countries like Mexico and Canada. The administration argued that these measures were necessary to level the playing field, protect American jobs, and encourage car makers to bring their factories and supply chains back to U.S. soil. The goal was clear: force automakers to invest in American workers and manufacturing plants, and ultimately revive a sector that many felt had been hollowed out by decades of offshoring and foreign competition. Supporters of the tariff saw them as a long-overdue correction, a way to restore pride and prosperity to communities that once thrived on auto jobs. By making imported cars and parts significantly more expensive, the administration hoped to spark a new era of domestic manufacturing. The expectation was that higher prices on imports would make American-made vehicles more competitive, leading to more jobs and investment at home, but the reality was far more complicated. The modern auto industry is a vast, interconnected global web. Car parts and components cross borders multiple times before a vehicle is even assembled. Engines from Canada, electronics from Asia, and steel from Mexico all come together in American factories. Tariffs threaten to unravel this intricate system, raising costs for automakers and creating uncertainty for both foreign and domestic companies. Executives worried about supply chain disruptions, production delays, and the possibility of passing higher costs on to consumers. Instead of the manufacturing boom that was promised, the industry braced for a period of turbulence. Car prices began to rise, showrooms grew quieter, and workers feared for their jobs as companies reconsidered investments and production plans. The stage was set for a high-stakes confrontation between government policy and a deeply interconnected industry, one that would test the resilience of American manufacturing and the global economy alike. The tariffs hit fast: 25% on all imported cars, trucks, SUVs, and parts, including those from Canada and Mexico. Automakers scrambled as their North American production strategies were upended overnight. Even China faced a 125% tariff, effectively shutting out Chinese vehicles and parts. The industry was thrown into chaos, supply chains were disrupted, costs soared, and long-term plans became obsolete. The White House made it clear: the era of globalized, tariff-free auto manufacturing was over. For automakers, the cost of doing business in America had just skyrocketed. The rules had changed, and the industry was forced to adapt, fast. The financial fallout was immediate. Detroit, the heart of America's auto industry, was hit with a shockwave that rippled through every corner of the city. Factories that once buzzed with activity suddenly faced uncertainty, and the mood on the factory floor shifted from pride to anxiety almost overnight. Within just a few months, $34 billion in new costs slammed into the U.S. auto industry. These weren't just abstract numbers, they translated into real, tangible challenges for automakers, suppliers, and workers alike. Assembly lines slowed, and executives scrambled to find solutions as the financial pressure mounted. General Motors, a symbol of Detroit's legacy, reported a staggering $1.1 billion loss in a single quarter. The company warned that annual losses could reach as high as $5 billion if the situation didn't improve. For a company that had weathered countless storms, this was a crisis unlike any other. Stellantis and Volkswagen, two other giants in the industry, also faced devastating blows. Their sales and profits plummeted, with both companies reporting multi-billion-dollar hits. Dealerships sat empty, and factories struggled to keep up with the mounting losses. Even Tesla, often seen as the future of American automotive innovation, wasn't immune. The company saw a $3 billion drop in revenue, blaming the uncertainty caused by new tariffs and trade barriers. Showrooms grew quieter, and the company's ambitious growth plans were put on hold. These losses weren't just numbers on a balance sheet, they meant less money for research and development, fewer resources for upgrading factories, and tighter budgets for worker pay and benefits. The entire ecosystem of Detroit's auto industry felt the strain. Ironically, the tariffs that were supposed to protect American manufacturing ended up draining the very companies they were meant to help. Workers protested, and the sense of frustration grew as the industry's future became more uncertain. billions of dollars that could have fueled the next generation of electric vehicles, created new jobs, and kept Detroit at the forefront of innovation, were instead lost to new trade barriers. The promise of a cleaner, more competitive future was put on hold. Detroit was under siege, the city's proud automotive legacy was at risk, and the industry's long-term competitiveness, both at home and on the global stage, hung in the balance. Automakers reacted with price hikes, production shifts, and tough cost-cutting. Ford raised prices on popular models from Mexico, Honda moved CR-V production to the US and paused a major Canadian investment. GM ramped up US truck production to offset losses elsewhere. Job cuts followed. Volvo slashed 5% of its South Carolina workforce, blaming tariffs. Some companies like Jaguar Land Rover paused US shipments entirely to reassess their strategies. Sales incentives and discounts tried to keep buyers interested as inventories piled up. The industry was in crisis mode, forced to rethink decades of business practices. Every move was about survival in a suddenly hostile market. The promise of more American jobs was quickly replaced by layoffs and uncertainty. In the late 20th century, as US automakers faced mounting challenges from global competition, the White House stepped in with a bold strategy. Rather than raising barriers, the administration negotiated special trade deals with key allies, Japan and the United Kingdom. These agreements were designed to lower tariffs on imported vehicles, making it easier for foreign automakers to sell their cars in the American market. The move was controversial from the start, sparking heated debates in both political and business circles about the long-term impact on American manufacturing and jobs. Under these deals, Japanese cars faced a reduced tariff of just 15%, while a select number of UK vehicles saw their tariffs drop to 10%. This preferential treatment was limited in scope, but significant in its effect, as it allowed foreign brands to gain a stronger foothold in the lucrative US auto market. For American consumers, this meant more choices and often lower prices, but for domestic automakers, it was a different story. In return for these tariff reductions, Japan made sweeping promises to invest billions of dollars in the United States. Japanese automakers announced plans to build new factories, create thousands of American jobs, and source more parts from US suppliers. The administration touted these investments as a win-win, arguing that they would help revitalize struggling communities and modernize the American auto industry. But in Detroit, home to the big three automakers, the mood was anything but celebratory. Executives were furious, pointing out that cars built in North America by American workers were still subject to higher tariffs than some vehicles shipped in from overseas. This, they argued, put domestic manufacturers at a competitive disadvantage and threatened the livelihoods of thousands of workers. Industry groups quickly mobilized, holding press conferences and organizing protests. They called the deals a betrayal of American industry, insisting that companies who had invested heavily in North American manufacturing were now being punished for their commitment. Workers feared layoffs, and local leaders worried about the ripple effects on their communities. Meanwhile, the European Union watched nervously as the US threatened even higher tariffs on European cars. The uncertainty sent shockwaves through global markets, with automakers and governments alike bracing for a possible escalation in the trade war. Headlines warned of rising costs, disrupted supply chains, and a new era of volatility in the auto industry. Ironically, a policy intended to protect American industry now seemed to be giving foreign competitors an edge. Showrooms filled with imported cars and foreign brands gained market share, leaving many to question whether the deals had backfired. The debate over trade policy became a central issue in the national conversation about the future of American manufacturing. As tensions rose, the rift between automakers and the administration deepened. What began as an economic policy decision quickly turned into a fierce battle over fairness, national identity, and the direction of the American economy. The controversy over special trade deals would leave a lasting mark on the industry and on the country's approach to global trade. The tariffs costs quickly reached American consumers. Analysts warned prices on imported cars could jump by $6,000, putting many models out of reach. Automakers tried to delay the pain by stockpiling inventory, but that buffer was temporary. As pre-tariff cars sold out, higher prices and fewer choices loomed. Some automakers considered dropping lower-margin models, shrinking options for buyers. The market risked becoming dominated by pricier trucks and SUVs, with affordable cars disappearing. For many, buying a new car was suddenly harder and more expensive than ever. Tensions exploded as the White House dismissed industry complaints, insisting tariffs were necessary and effective. Commerce Secretary Howard Lutnick told automakers, "Build in America or pay the price." The administration claimed automakers secretly supported the Japan deal, an assertion industry leaders flatly denied. The American Automotive Policy Council launched a public campaign, calling the tariffs catastrophic and the trade deals unfair. The clash revealed a deep disconnect. The government pushed for nationalism, while automakers relied on global supply chains. With both sides entrenched, compromise seemed impossible. The industry and the administration were locked in a bitter standoff, each blaming the other for harming American interests. The fight moved to the courts, with opponents arguing the tariffs exceeded presidential authority. A federal trade court ruled most tariffs illegal, but auto tariffs stayed in place pending appeal. This legal limbo left automakers paying billions in duties with no guarantee of relief. Ongoing negotiations with the EU and threats of new tariffs made long-term planning impossible. Major investments were frozen, companies couldn't risk billions on shifting policies. The industry was stuck in a cycle of uncertainty, unable to plan for the future. Every decision was clouded by legal and political unpredictability. The health of the North American auto sector hung in the balance. By July 2025, the American auto industry faced a crossroads. Ongoing tariffs and special deals for foreign competitors created an unsustainable model for domestic automakers. Profits eroded, job cuts loomed, and new car prices climbed. The best hope, a legal or political reversal to restore tariff-free North American trade. But with the administration holding firm, uncertainty was likely to persist. Automakers would need to adapt, possibly shifting to more localized but less efficient supply chains. The industry risked becoming smaller and less competitive on the global stage. For car makers, workers, and consumers, the road ahead promised more challenges than ever before.